Today we're going to be looking at the Courier for the appropriate measures and metrics that we're going to be using in the simulation. As we've already discussed in class, there are a number of measures and metrics that are extremely important for management to look at, review, understand, and employ in their performance of due diligence. On page 1, we effectively have 4 measures that are really important to us. The first one is return on sales. Basically, this shows us, if you will, the efficiency of the sales dollar. And so, for example, if we take a look at Andrews is 22.7. We can convert this into pennies on the dollar. So, for example, Andrews represents almost 23 cents on the dollar. So for every dollar in revenue, Andrews is going to generate income of 23 cents. Now, this is very important from an analyst perspective. It's also extremely important from a managerial perspective, because if we increase our revenues, we can have this associated increase in income. If we take a look on the other hand at Ferris, for example, Ferris is only at 4.2%, or roughly 4 cents. So if Andrews and Ferris both increase their revenues by a single dollar, Andrews is going to be earning more money effectively to their bottom line. So you can see the $177 million in revenues from Ferris are not as effective as $148 million in revenues from Andrews. We also have the same thing for ROA, return on assets. Again, this effectively is showing us how effective we are in utilizing the assets of the corporation. And in this case, if we take a look, we can see Baldwin's at 25.4%. So they effectively are earning 25 cents for every dollar in asset that they have. Again, the key behind it is one of the things we need to be careful, unlike ROS. ROA may imply that we're working our assets too hard. But still, the goals are to have a positive ROA. For example, 17 cents on the dollars we see with Andrews, or 12 cents on the dollars we see with Erie. So the key behind it is, the second important measure here is effectively the efficiency of our assets. If our asset efficiency is very low, in this case, if we look at Ferris, and Ferris is at 4.8%, that means that we're really not using our assets optimally. So we need to take a review of our asset base and find out what it is we may need or may want to do with it. We may want to sell. On the other hand, if we're Baldwin, we may want to determine, is it feasible for us to purchase additional assets, thus to reduce the burden. The third one here is a comparable unit of measure, namely return on equity. And this talks about equity dollars as opposed to revenues or assets. And again, as you can see, Baldwin is most efficient with the equity investments they get. And then we see Erie is in second. What this tells us, at least at a very macro level, is that these companies are employing this investment dollar, in this case equity dollar, much, much more effectively than, let's say, for example, Ferris's in our data as we look at it. And this is very useful from a perspective, especially when we're going to be issuing shares of stock. This may give a potential investor, potential stockholder, an idea of how well we convert their money into usable dollars for the corporation, so to speak, net income. The idea behind it is, though, we have to be very careful with these 3 measures, because we can impact their number, their value, their metric, by possibly not investing in the future. So these are really first step, first stage measures. From here, we have to look further. We have to look at why is Ferris 4.8 for ROA as opposed to Baldwin's 25.4, or why is Andrews 22.7 compared to 5% for Digby, and so on. The fourth and final measure that's important to us on this first page is the contribution margin. And remember, as we've talked about it, the contribution margin represents, if you will, operating dollars. When we think of it and when we see it from our P&L, Basically, what this refers to is the revenues minus the cost of goods minus any inventory carrying costs gives us operating dollars to run the business unit, to run the effectively that department, that product line, whatever the case may be. In our simulation, historically, we pretty much have an idea that we need to have at least 30+%. As you can see in this case, we see Erie is extremely efficient in producing operating dollars. That has a GM of over 52%, which means that its revenue dollars are generating more operating dollars than, let's say, for example, Digby, which is at 34%. The key behind it is if we have a GM that is 40, 45%, even 50%, what we may want to do is we may want to take a look at the prices we're charging and determine, is there some way that we can competitively use that to our advantage? Can we drop the price slightly, bring our GM down maybe 5 or 6 points, and in the process capture a large market share because our products are accepted and our products are going to be more reasonably priced. Now, these are some of the things we look at. But when we look at the GM for every company, Andrews, Baldwin, Chester, we can see each and every one of these companies has a GM in excess of 30%, which according to market measures is appropriate, is acceptable. What it does tell us is the higher the GM, the more operating dollars I get, so to speak, from my part one of my P&L. And that is extremely important because the more marketing dollars I get, the more sales dollars I get, the more funds I have to purchase capital equipment, the more expansive the corporation can be, the more successful it can be. So the key behind it is operating dollars is the key. And if we have sufficiently left over, net margin, so to speak, we can then go ahead and issue dividends, which then start to drive our stock price up. So these represent, if you will, part one of our page in our simulation. Page 2 of the Courier has a series of measures and metrics that are more important to the finance department than they are to other managers. However, there are some measures on page 2 that are of interest to all departmental managers. And so, for example, what we may be interested in this case here, is if we take a look at the stock price. The stock price for a particular company represents, if you will, the value investors have placed on that corporation. And as we can see, for example, in this case, when we're dealing with Andrews, Andrews has a stock price of $54.88. The second measure on the screen that's important to us is the change. How much is that stock price has gone up and down? And as you can see in this simulation, all the stock prices for every company have gone up. What we can see is that Baldwin stock price has appreciated the most at $33 per share. They're almost $34 per share. The third parameter here that's important to us is the number of outstanding shares. Now, this is extremely important because many of the parameters on this screen, as well as many of the KPIs that we employ, use shares as part of the calculation. And the shares as a denominator implies that the larger the number of outstanding shares, the lower the number is going to be by definition. So when we take a look at Andrews and Baldwin, as an example, we can see that Andrews has almost a $55 per share price. We can see Baldwin has a $61 per share price. So very quickly we can look at these two and say, well, all right, does that automatically imply Baldwin is a much wealthier company? The answer to that question is really no, because if you look at it, Baldwin has roughly 3 million shares outstanding compared to Andrews, which has 5 million. And this then is reflected in the next measure that we see, market capitalization. And so market capitalization, if you will, represents a total value of the outstanding shares that we have, the share price times the number of shares. It gives us an idea of the size of the company. It gives us an idea of the wealth of the company, or if you will, the value of the company. Again, purely from a stock perspective, not necessarily future products, product market share, and other elements. So in this case, if we look, we can see Andrews and Chester effectively are the two wealthiest companies, and then we have Ferris coming in third. So even though we look at one parameter, we need to be able to essentially evaluate all of them. The fifth parameter that is very interesting and very important to us is earnings per share. Now, earnings per share, again, is net income minus dividends paid divided by, again, the number of shares outstanding. So we have to be very careful that a lower EPS doesn't necessarily imply a less value. It just may imply that there is, in this case here, far more outstanding shares. So in this case, Andrews, in almost every one of these types of KPIs that are going to use outstanding shares as a denominator, are effectively, with equal dollars, is normally going to be lower. Obviously, if the denominator is large, the number is going to be smaller. The key behind it is, though, what EPS tells us, what earnings per share is, that the higher it is, typically, the more likely the company is going to be to issue dividends. So these are some of the elements that we see. So this page 2, if you will, of the Courier is a very important one from primarily a financial perspective. All the other managers are obviously going to take a close look at this. For example, we're going to look at the incremental change in the stock price. We're going to look at the earnings per share, and we're going to look at the market capitalization. On this page also, we have some other parameters that are extremely important to us. Namely, if you will, the credit rating. And what the credit rating here represents is essentially the price one is going to pay for long-term debt, the bonds that are being issued. And what a AAA rating compared to, for example, a CCC rating, as we can see, Andrews to Digby, is that effectively for the same dollar borrowed, Andrews is going to be paying less for that dollar. So if the corporation is going to be issuing long-term debt to essentially construct long-term assets, which is normally what we do, we would want to have as high a credit rating as possible. The higher the credit rating, the less we pay. The less we pay will be reflected, as we've discussed, in Part 3 of the P&L, where we talk about interest, taxes, and interest. So the key behind it is, one of the things a finance manager should always have control of and should be consistently looking at is this credit rating. Now, yes, obviously, it's superb to have a AAA rating, but it may not be necessarily that important to have a AAA rating. Maybe a single A is going to be effective for our needs at this point in time, considering cash flow and many other elements. So page 2 is really the portion of the Courier that is of most value to the financial manager, the CFO, if you will, of the corporation. Page 4 of the Courier is a report that many different managers are going to use. Marketing is going to use this. R&D is going to be using this page for the information it contains, as well as production. When we take a look at it, we have a number of different areas. Let me just go over those. First of all, the first one is the inventory component, and it shows us the number of units sold and the number of units remaining in inventory. And as we discussed, the 10% rule is a good rule of thumb. What the 10% rule tells us is that the remaining inventory should be 10% or less of what was sold. So if we, for example, take a look at Adam. Adam, in this case, sold 1.6 million units, has 140,000 left in stock. That is within the 10% rule, and as a result is very good. Let's take a look at AF. AF sold 422,000 units in this case here, and it has 24 units left in stock. On the other hand, if we take a look at, for example, in this case here, Ari sold 286,000 units and essentially has 240,000 units left. So that really is exceedingly high. So our goals are to essentially attempt to have a forecast, a sales projection, and the remaining inventory should be under 10%. Now, we don't want it to be zero. Why don't we want it to be zero? You would say zero means we have no inventory left in stock, therefore we have no inventory carrying cost, and therefore our GM is going to be as high as it is as it can be, excluding the fact of inventory. Well, the problem is using that what we have is we have no information about potentially how many more units we could have sold. So in this case here, if we take a look, for example, at Able, sold 2 million plus units. Take a look at Acre. It sold, in this case here, roughly 2 million plus units as well of the product line. The key behind it is we don't know. Could it have sold 1,000 more units? Could have sold another 1 million units. So the problem that we have, and we have stockouts, is the simple fact that, number one, we don't really have any information about what could have been. We also know that we have customers who may have wanted to buy our product and now are disgruntled because they were not able to. And remember, that will impact the December survey. The second set of values, if you will, in our page 4 of the Courier report really has to do with, if you will, the value proposition of the product. And the value proposition of the product is essentially composed of, as we've discussed, age, MTBF, size and performance, and price. And we know, for example, that the only one that can be changed without impacting the age is the price of a product. So the marketing manager, who's looking at a value proposition, and the R&D manager both need to be looking at the value proposition. That really is the job of R&D, and a secondary set of conditions in terms of promotions and sales on the part of marketing is to look at the continuous alignment of the value proposition within the market segment and the value proposition of the product. So the key behind it is this report pretty much gives us an idea, if you will, of the VP of each and every one of our products. We now have to compare it to the need, the desires of each of the market segments, and that becomes the next set of pages we're going to take a look at in a moment. The third component really represents the production purview, the cost of goods of an item. And as you can see over here, what we have is the material and labor costs giving us the product GM. So even though we may be looking at a very high GM for a product, I believe we saw Erie was at 52% GM in this particular case, in this one case, we may want to look at the GM of a particular product. For example, we take a look at this brew product here. Baldwin has an 88% GM, which I mean is exceedingly high. It's very good. Has a 50% GM and a second shift of 88%. The key behind it is the GM for this product could even be higher, because notice we're running 38% above second shift. So what the production manager needs to do is the production manager needs to look at page 4 of the Courier report, specifically the material cost, labor cost, and indicate what do I have to do to essentially get that margin to at least be 30%. If you take a look at the Andrew products, you can see, for example, Aerie is at 24%. You can see that Aft is at 27%, and you can see Adams at 54%. So obviously, Adams is a superb product. It follows the 10% rule. It's generating more than 30%, almost double GM in this particular case. We're selling a considerable number of units, so it really is a very good product line. Well, we now go to essentially the next level of information on this page, and that's namely the infrastructure. And the infrastructure of a particular product gives us a lot of insight. In this case here, what we can see is we have two elements, two components associated with the infrastructure. In this case, what we have is the automation and the capacity. So as you can see, for the Atom product line, it only has capacity for 750,000 units. It's selling 1.6 million units. It's running at 198% plant utilization, which really means the production manager in this case must start to add infrastructure. It cannot continue to exist in such a constrained environment. we need to get the plant utilization down to at least 150%, which means we need to add capacity. Now, they already have a high automation level, which is very good, a max being 10. So this is an area where the production manager is looking at this and is sitting there and saying, what I need to do is I need to add infrastructure. Now, marketing looks at this also and sees, for example, the margin is at 54%, which means that what we could probably do is we could probably work with price and put some extreme competitive pressure on our competition in that particular market. So when we look at this page of the Courier, we see there's a lot of different elements and components that are important to various functional departments. The marketing department is interested in the units sold, the remaining inventory, the revision date. The R&D and the marketing department is interested in the value proposition. The production department is interested in the cost, labor, and material, and the margin, the automation levels, the capacity, the second shift, and so on. So this page of the Courier is an extremely important one for us to analyze. The other thing to remember is this is where we see product-based KPIs. And that really is an extremely important element in understanding the functional productivity of our departments. The last point to mention here is if you look at the contribution margin, the percentages that you see here, you can transfer those percentages to the P&L by product line that we'll discuss later on, and automatically not have to perform any of the calculations that are already done for you. The next 5 pages of the Courier are essentially employed by marketing and R&D. It represents, these pages contain information on the market size, on the value proposition, on the accessibility of the product, the awareness, the December survey, and so on. So essentially they're all exactly the same, except the measures and metrics may be rearranged depending upon the weight placed on it by the customer in the particular market, and the metrics themselves may be different. So let's take a look at what each page contains and the information that's on it. First and foremost, it shows us the current size of the market in million units. So for example, the traditional market in this particular round has almost 12 million customers in it. It's projected to grow by 10%. So this is a very important measure for the marketing manager. Why? Because what it tells, and obviously for production to understand in the potential forecast, what it tells us is that we probably will have around 13 million units for sale in the coming fiscal year. So that is the starting point for the marketing manager to craft a forecast. That will then give them an indication that if we have 10% market share, we're going to expect to sell at least 1.3 million units, depending upon how we promote it, depending upon the awareness, the accessibility, and so on. So really, this becomes the starting point. Now, we have to be careful, of the market growing, the market contracting. It isn't an absolute number, but it gives us a pretty good reference point. The second set of KPIs, the second set of elements that are extremely important here is, if you will, the value proposition, or as it's called in the Courier, the buying criteria. And so the value proposition, as we've discussed, essentially is made up of, if you will, 4 components: the age, price, position, and reliability. The age, in the case of the traditional market, the customers in the traditional market, those who are buying, they are interested in an age of 2 years old. And they have placed, as noted, a relative importance or weight of 47%. So that's the number one characteristic of the VP in the traditional marketplace. Now, if you compare that to low, you'll see that the number one criteria in low is price. And the number 2 criteria is age. And the age is 7 years old in low and has a relative weight of 24%. So this gives you an idea of the differences, if you will, and the value being placed on different, think of it as features of your particular sensor in each and every one of the market segments. So looking at this, what we can see is that we have the age, and the age happens to be the number one value component. We see price is number two, and the price has a range. Now remember, as we talked about it, the higher the price is at the leading edge, if you will, of the particular product line. The lower price is at the lower edge of the particular product line. So the market segment. So the key behind it is the beauty of price is that you can modify price in a market segment and not impact age. On the other hand, the next two components of the value proposition, the size and performance and the MTBF, if either of those is revised, we are automatically going to half the age at the time of the completion of the set of revisions. So unlike price, which marketing can change as the product essentially glides through the market segment, the size and performance and the MTBF, well, R&D has to be extremely careful in deciding whether to change those products or not. Now, one thing to remember is the lower the MTBF, the lower the cost of goods. The higher the MTBF, the higher the cost of goods. And just like price, the higher reliability is at the leading edge of the market, the lower reliability is at the trailing edge. But again, remember, just think of traditional. As traditional, the product moves through traditional and eventually moves into low. If you try to revise, let's say, an MTBF of 19,000 to 14,000, and the product is in near entry into the low market, it could be age 3, 3.5, maybe 4 years old, even 5 years old. All of a sudden, you're going to cut the age in half, 2.5, and so when it enters the market, the low market, it's going to be 2.5 years old, where the number two characteristic of the value proposition in low is an age of 7 years. So the key is it's very important, and this is where R&D has to be able to essentially understand, if you will, the product flow through its life cycle from high, traditional, low. Now understand size and performance markets don't have this. Size and performance need to be re-engineered as opposed to life cycle of products. Some of the other elements of this page, it shows us, for example, if you will, in this case here, the accessibility of a product. That is, how easy is it for someone who wants to buy the product to be able to buy it? And as we can see, Andrews essentially has 100% accessibility. That means anybody who's interested in buying the product in traditional is going to find a place that is selling the Andrews product line. Not a problem. On the other hand, take a look down here at Ferris. Ferris is only at, let's say, roughly maybe 6%, 7%. That means 93% of all customers who are interested in the Ferris product line may have difficulty in purchasing that product. Now, Ferris may not be selling a lot in the market, so therefore that's not really a big issue. But think of it, 93% of 12 million customers, 93% of them are going to have difficulty in finding a place that sells a Ferris product line. So accessibility represents the ease in which a customer can purchase a product, your product in particular. The other thing to remember is accessibility is for all of your products in a market. So let's say, in this case here, we can see even though Baker is more in low than it is in traditional, Baldwin, assumed from the perception map we see, has two products in traditional. That means the Baldwin sales force sells both of those products. Accessibility is for the company's product, not for a particular product. Even though you can hire salespeople by product, take that into consideration. The other interesting parameter here is if you hired an outside consultant, and the outside consultant came in, looked at your forecasting capability, looked at your projection capability, pricing, everything else, and said, you know, I think you should have been able to sell X number of units. Well, that's what this chart tells us. This chart shows us, for example, in this case here, Chester basically not selling roughly 8-9% it could have sold 8 or 9%, according to the consultant. Now, it may not be 100% right, but according to the consultant, Chester potentially could have sold 8 or 9% more. Now, in all likelihood, this probably means underproduction. All likelihood, this means under forecasting. Now, the important thing to remember is who picked up that demand? Well, you can take a look in this case. You can see Erie did. You can see Digby did. You can see slightly Andrews got a few of it. And we can also see that Baldwin. So in this case, the other element here is this consultant, if you will. Now, what it represents, if you look at it, is potentially based on the knowledge this consultant has gathered, based on the data, the statistics, and all sorts of other parameters. This is their best guess estimate of what you may have done. Now, if we look further down on this, and we start to look at the actual numbers in this case, what we can see is, notice every one of the Chester products, in this case Baldwin also, but every one of the Chester products stocked out. We also can see that in some cases, Digby had no stock out. So we know Digby sold more than what it theoretically should have because of the lower production lines of stockouts at Chester. So this pretty much gives us an interesting perspective on the information that we had. In addition to that, there are some other parameters here that are very, very important, especially to marketing. And these parameters represent, if you will, the customer awareness that we see, and as we discussed briefly, the customer accessibility. A customer awareness means how much of the market is aware of your product. So as you can see, in this case here, Digby, Erie, for example, have a 71% awareness. That means out of 13 million, 12 million plus customers, 71% are aware of the Digby Days product line. 73% are aware of the Erie Egg product line. Only 37% are aware of the Adam product line. And it is selling at a 14% market share. So very quickly, one of the things that Andrew's marketing manager should look at is increasing the awareness. Why should they be interested in increasing awareness? Well, because if you look at the accessibility, they have spent a lot of money in hiring salespeople. They really should also be spending a lot of money on letting the market know their product exists. So these are some of the components. And again, for ease of use, you see the value proposition being repeated here as it was from page 4. And the last element here is that qualitative number we talked about, namely the December survey. And for example, if you take a look at the Cape line, the Cape line has a 63% customer survey. That means it is considered by the market, the company Chester and the Cape product line, one of the highest, if not the highest in the market. Unfortunately, Cape was underproduced. Thus, it didn't sell as much as it should have. So it's giving some of its competitive advantage away. So all of the other 4 pages for Low, for example, all follow suit in a similar manner, similar fashion. And as you can see here, the interchange of price, for example, and age compared to age and price. So whereas age was the number 1 parameter in traditional, and price was number 2, in the low market, price is number 1 and age is number 2. The size and performance remain relatively in the same position, even though the weights are less, and the values have obviously changed. So marketing and R&D need to look at these different market pages for a low, traditional, high, and size and performance, and perform the same analysis on an annual basis. The HR page essentially reflects the two decisions human resources executes in the simulation. Basically, human resources can uh, recruit employees and can train employees. The higher the recruiting dollars, that is, the higher the funds that are spent to recruit employees, the better the quality of the employee. So that means we're going to get a better worker if we spend a lot more money recruiting. In addition to that, the more training we provide, I believe it's up to 80 hours a year, the more training we provide an employee, the more productive that employee becomes. So the key behind it is HR basically is looking at recruiting high achieving individuals. HR is looking at essentially training the individual to become even more productive. Now, the converse of that is if we have lower recruiting dollars, zero recruiting dollars, for example, zero recruiting days, this contributes to a high employee turnover. And so when we look at the results, the KPIs of the HR department, we're really interested, if you will, in two sets of numbers. We're interested in employee turnover rate, which is theoretically a combination, if you will, of the recruiting dollars and the training dollars. And we're also looking at productivity. The productivity, again, is a result of that. Now, you can see over here how much we spend in terms of recruiting costs, for example. You can see how much we spend in terms of training costs per employee. And those are, again, reflected, if you will, in the two KPIs, namely productivity index and turnover rate. And so our goals are, if you will, to keep an employee turnover rate of between 8 and 9%, which is pretty good. I mean, obviously 6.4% is excellent. The only problem is it costing us too much to do that? Now, again, this represents a cumulative employee turnover rate. It isn't something that occurs overnight. And so the element here is we can see that in this particular case, the recruitment dollars on the part of Chester and the training dollars on the part of Chester are quite low, which means that Chester's HR manager has obviously cut back this fiscal year on its expenditures because it realized that it really was driving its numbers way too low for the associated cost. But notice the benefit. We almost have 130% productivity. That means labor productivity is extremely important, which is going to be reflected in cost of goods. But understand the counterbalance. The counterbalance of that means that if we have high automation and low, we have less labor. So this may be more reflective, if you will, in the case of the performance and size markets or even the high market. It all combines together. The key is what we're interested in as a human resource manager is to make sure we have an employee turnover rate between 8 and 9%, no more than 9%, and that we have a productivity index that is at least 110%. That then is telling us that we're getting a productive human labor workforce. That means that the training dollars we're spending is not being thrown away, and so on. So these are some of the important elements. We also will add labor negotiations. And every year 4 and year 8 in the simulation, the HR department has to then go ahead and negotiate, whether it's in wages, benefits, profit sharing, and raised percentages, and so on. With that, it represents a every 4-year period effort that needs to be performed on the part of HR. Now, there are many things that get included in that. For example, to give you an idea, profit sharing. Now, every company in the industry we're looking at right now is profits. So that is an academic point. But imagine a company that had losses. What good is there in profit sharing if there is no profit to share? So in a company who is negotiating with its workforce has a loss in terms of its P&L, you may have to negate the benefit of profit sharing, put more money into benefits and wages, which is actual expenditures, not based on performance results. So these are some of the elements that need to be considered as the human resource manager starts to take a look at it systemically, how they interact with the rest of the organization. The last two documents we're going to take a look at are the balance sheet and the P&L. First, let's take a look at the balance sheet. Basically, what we're most interested in the balance sheet are the top three line items. Obviously, we're all aware that the top three line items are based on liquidity, cash, receivables, and inventory. What we always want to see is we want to see, for example, cash going up. And so in this case here, cash went up from $77 million to $128 million. Fantastic. That's exactly what we want to see. We also want to see accounts receivables improve proportionately to the improvement in the revenue numbers. So if the revenue numbers, this looks like approximately 8-9%. So if the revenue numbers for Andrews went up about 8-9% between 2025 and 2026, then this is perfectly acceptable. So the idea behind it is, what we want to do is we want to say keep AR constant. That is the ratio of AR. So we go from 100 million to 200 million. Obviously, we're going to see a double of the AR, but the ratio remains constant. The last component that is very important to us is this inventory number. We always want to see this inventory number either be equal to or less than prior year's inventory number. Now, we don't want it to be zero, because that means we stocked out completely. Again, assuming in our simulation. So in this case here, what we can see is inventory went down from 38 million to 10 million, which is excellent. They were able to effectively cut it by 60-something% and reduce it. We also want to be able to take a look at this information on the liability side, where we want to deal with, in this case here, payables, current debt, and long-term debt. Again, current debt, in this case, because we have 128 million in cash, obviously current debt is zero, relatively acceptable that we have that. Payables is feasible, and long-term debt is a reasonably good percentage. But just like we've seen the above, we want to always see payables going down and, effectively, not increasing. We want to see current debt going down or remaining constant, and we want to see long-term debt, slightly decreasing over time. Again, the idea is, unlike consumer, debt is important to a corporation. We always want a debt-to-equity ratio of at least 1. So the balance sheet is a very quick cursory review, mainly to say, how much cash we have. And again, understand, as we have discussed, there's a difference between accrual numbers and cash numbers. So having cash in bank is an extremely important characteristic of a successful corporation. And in our simulation, obviously, that gets reflected with emergency loans, which, if you remember from the first page that we looked at, no company in this industry had emergency loans. So we want to make sure that we're always improving our asset position and our liability position. The last document we want to take a look at is essentially the P&L, the income statement. And as we've discussed, the income statement is represented by three different parts. Part 1, which essentially is the GM component, revenues minus cost of goods, any inventory carrying cost. Part 2, which theoretically represents the expenses and results in net margin. And then Part 3, which effectively takes into consideration interest and taxes, profit sharing, and gives us triple net or net profit. So the key behind it is, first and foremost, what we want to do is we want to make sure that we understand the GM. So in this case here, the aggregate gross margin for the Andrews product line is 39.7%. But as we can see, Able is 36%, Acre is 44%, and for example, in this case here, Adam is 54%. So now what you may want to do is you want to be able to essentially take this from the production page, which shows you these percentages, and merely put them on. So in this case here, we can see After's at 27%. We can see, for example, that Adam is at 54% and so on. So this provides us with a little bit more insight. So let's take a look at what we have here. First and foremost, remember, our goals and objectives are to make sure that we have a GM of 30% or greater. And yes, we can say we do. And we can look at each one, and we can see the AF product line is running at about 27%. We can see that in this case here, at the ARI product line is running at about 24%. And other than aft, everything else is exceeding 30%. Well, that's part one of the analysis. And really it has to do with holding costs and so on. And we can see that the inventory carrying cost isn't that great for aft. So we need to find out, why is our labor and material costs much higher? And again, it could have to do with the department. It could also have to do with the pricing structure, whatever we may want to take a look at it. Then what we want to do is we want to look at part two. Now remember, how does the P&L work from this perspective? Well, the P&L works from this perspective in the sense that we have operating dollars. So let's take a look at, for example, Adam. Adam has almost 20 million operating dollars coming to, if you will, operate the Adam business unit, the Adam product line. Now, what are the expenses that we employ in the simulation? Remember, part two of the P&L are expenses. And so the first expense we see is really a paper expense that does not impact cash. So remember, always looking at two things. We're looking at accrual profits and we're looking at cash. This represents, if you will, the change in assets due to depreciation, and we see on our balance sheet that obviously we're reducing our asset, we're therefore taking a loss by that reduction. So yes, the Adam product line infrastructure is going to be reduced in value by $2 million, and we need to reflect that. Now the beautiful part of that is this is a non-cash expenditure. This is a non-cash loss. So therefore, in reality, we're not making only $14.4 million in net margin. We're actually bringing $16.5 million in cash into, theoretically, part one of our bank account process, if you will. But what else do we see? Here we see our promotion. This is where we're promoting the product to increase and improve awareness. We see the sales number. This is where we're looking at accessibility. And then the administrative cost, which is a function of the capacity and so on, which gives us a total expense, including the depreciation of $5.5 million, which then leads us to $14.5 million in net margin. Now, if you remember, we discussed a net margin of anywhere from 10 to 15% was considered very good. In this case here, Andrews is running at 22%, well above industry expectations. And this is what we need to do with our P&L. We need to understand that, yes, AFT may only be giving us 27%, ARI may only be giving us 24%, but in ARI's case, for example, what we did is, and again, we have to look more closely at the product and so on. In ARI's case, the question we need to be asking ourselves in this is, why did we spend X amount of money? Where did we spend that dollar amount? Because we did have a net accrual loss of almost $1 million. So the key behind it is what we want to be able to do is, even though theoretically we lost only about $600,000 in cash on that, our question that we need to ask ourselves is this a new product? Are we just promoting this product? What is going on with it? And so on. Obviously, you can see the depreciation numbers are relatively low. So it either may be a new product line that is just starting up, or maybe a product line in size and performance. But we need to analyze it a bit further, because what this is telling us is that our expenses are exceeding the operating dollar. Yes, granted, we have $14 million we're bringing in the Atom, and we're going to take, $935,000 of that and give it to ARI to continue its operations and so on. The question, though, is, why is it that we're losing money? And can we justify losing money because we're growing the products in its early stages? So this is the analysis that we need to take a look at. Then we come to the third part, and the third part tells us to look at the interest expense that we have. And in this case, you can see the interest expense is relatively low. And again, rationale, I believe we ended up having roughly $120-something million in cash. So Andrews, in this case, decided to pay down not only their short term, but I assume portions of their long term. And then lastly, we have $18 million going into taxes. And so as a result of that, we ended up with a $33 million profit, well exceeding our expectations of 5 to 7%. So this is how we view the P&L. And the goals and objectives are to essentially look at a particular product line and understand why it is doing exactly what it's doing. Now, argument's sake, let's assume that Atom or Ake are products that are in low and eventually going to be transitioning out and we're going to have to terminate it. The question is, what product line do we have that's going to replace the one? Notice in this case, Andrews has a slot for one additional new product that can be introduced. So we use the P&L to effectively manage our business. Part 1, Part 2, and Part 3 of the P&L all provide us with different information. Other, as you can see in this case, was a negative, which implies that they sold some kind of infrastructure, and that infrastructure theoretically generated them a profit. And so either we can have a positive or negative in that case. So this implies that maybe they sold infrastructure that had been fully depreciated but still had value in the market. And so the key behind it is this is how you look. And every manager should be looking at the P&L by product line to essentially understand how their P&L responsibility is contributing to the triple net and the net profit of the corporation. Now that we reviewed the Courier for a second time, it's important to start to develop a series of measures and metrics that the corporation and the departments are going to use to effectively determine whether management is performing their tasks successfully or not. To do so, individually, each of every one of you should think of 2 or 3 performance measures. Now remember, these are result-oriented measures. They reflect an effort and an associated metric that you can employ to ascertain whether a department or whether the corporation is successful. For example, market share. Now, these measures and metrics may be based on product, they may be aggregate measures. Again, understand they need to be performance-based. They need to be results of efforts that each and every manager undertakes, and they also have to reflect their combined benefit to the corporation. So as you've gone through it, go back through your notes now, take a look at the measures and metrics, and for every department in the corporation except TQM and the corporate entity itself, select 2 or 3 what you believe to be good performance measures and associated metrics. Once everyone on the team has done this exercise and has their list, if you will, the next step is for the team to discuss. Now, obviously, if every team member for the marketing department has picked market share as the appropriate measure, then obviously that appears to be the most important in everyone's mind and should be taken into consideration as the finalized metric that marketing would use. What you should do, though, is go through your entire list and essentially come up with 2 measures and corresponding metrics that the functional department manager can modify accordingly for each and every department and for the corporation. And this is what you're going to use in our first simulation round, our first real round, to test the selection of the KPIs that you have picked, the selection of the measures and corresponding metrics. See how well they reflected what you did. See how well they are. And again, we're going to have a lecture that's going to talk about measures and metrics in much more detail and show you about the concept of optimistic versus pessimistic measures and so on. But for now, see how well the measures the team has selected reflect, if you will, the success of the corporation in each department. Refine accordingly for round 2. Once we get into round 3, as you notice in the template of the memo, we're going to start to look at collecting this data. So basically, this is the preliminary step to getting to a set of measures and metrics that we in each and every department can use, and that the corporation, the CEO, can essentially employ to ascertain that the company is successful. So this really becomes your next exercise, to come up with a preliminary set of measures and metrics for each department and for the corporation.